Hi, I'm Kayla, an Assistant Branch Manager and a member of the Financial Education Committee here at Members First. Today, we're going to talk about credit. A credit score is dynamic and can change positively or negatively depending on how much debt you accrue and how you manage your bills. The factors that determine your credit score are called the 3 C's of credit: character, capital, and capacity. Character. Will you repay the debt? So, we can't just take your word. We will look at your history of paying bills on time. Do you have a good credit report? Capital. What if you don't repay the debt? Do you own anything that we can use as collateral? Your house, your car, savings, or investments? Capacity. Can you repay the debt? Do you have a job? How much money do you make? Do you have other debt? How much does it cost for you to live, i.e. your rent or your mortgage or something like that? These are some of your responsibilities when it comes to loans and credit as a consumer. Only borrow what you can repay. Read and understand the credit contract. This is a big one. Pay your bills on time. If you're unable to make payments, notify the creditor. They are more likely to work with you when you approach them. Something stolen, report that immediately. And never give your personal information over the phone unless you are absolutely sure who you are talking to. What does your credit score mean? Generally speaking, a good credit score is anything above 700 points. However, if you look across the internet, you'll see that everyone has their own opinion. Every single lender has their own criteria about determining an individual's creditworthiness. 711 is the national average. That's great. Here are a few credit influencing factors that are commonly used in calculating your credit score. Although the actual credit score number may differ depending on what credit bureau you use, Equifax, Experian, or TransUnion, they all pool the information and what kind of credit score model is used. So, your payment history. This has been a common theme through the presentation, but it is very important. We need to see if you're able to make payments on time. Amounts owed. How much debt do you have? Length of credit history. It's hard when you're young, just starting out, to have an extensive credit portfolio. So make sure the credit that you do have is up to snuff. New credit. Opening lots of credit cards all at once is not recommended. Think about your different options when opening new cards or loans. Here are a couple steps you can take to help build your credit. Try not to job jump. Keeping a job for a longer duration is helpful. Pay your bills on time. I know, but this is the last time I'll mention it. Keep your bank account in good standing. No bounce checks, no overdrafts. Apply for low-limit store cards or get a secured card through your local financial institution. And if you have someone that is willing to co-sign for a loan for you, that will help your interest rate be lower. If you aren't sure why your credit is the way it is, I recommend pulling your credit report. You can pull every credit company once a year for free. Annualcreditreport.com is the only website you should be using. They will help you pull either TransUnion, Equifax, or Experian. You will need to provide some personal information, so be prepared. Thank you for watching. Hopefully these quick tips will help you as you embark on your credit journey.